Most people will get overwhelmed when they see a loan estimate or closing disclosure. It's a 3-page document that includes lots of information such as monthly payments, fees, expenses, rates, and a lot of things that make it difficult to understand for the average person. So they'll do one of two things. They'll either look at the rate or the cash to close, and they'll decide what they believe is the best deal for them based off of those two things. Now, this is where lenders can hide a lot of extra fees, and what most people don't realize is that you might have the same rate as somebody else, but you could be paying a lot more in hidden fees, and that could cause you to have a worse deal than them. Now, in this video, I'm going to show you how to properly compare multiple loan estimates so that you can make sure you're getting the best deal whenever you're purchasing or refinancing a home. But before we can do that, we need to take a look at what actually goes into a loan estimate and understand where all of these fees are coming from so we can make a better informed decision. So let's start with the first page of the loan estimate. This is where most people will take a look and then just make a decision. This page includes your expected monthly payment, the rate, and your cash to close. So the rate is important as it dictates the amount of interest that you pay over the course of your loan. It's an important factor to look at, but it shouldn't be the only thing that you look at when comparing rates. The next thing people will look at is their expected monthly payment. This is based mainly just off the rate, along with your expected property taxes and your insurance. And then the last thing on this page is the cash to close. This is where it gets a little complicated and confusing for most people because this includes a lot of extra costs in certain loan estimates such as points and origination fees that make it very different across lenders. Another thing that most people don't talk about is that this cash to close also includes your expected escrows and prepaids. And on a loan estimate, there's no threshold for how accurate these have to be. So one lender may be underreporting these escrows and prepaids and then fixing them later to make their deal look better. Now, in the end, no matter who you go with, your escrows and your prepaids are going to end up being the same because they're based on your property taxes and your insurance, which are things that your lender doesn't control. So now that we understand that, let's take a look at all of the actual sectional costs that make up these closing costs. So we'll start with sections A through D, which are the loan costs. These are the costs of actually doing the loan. So section A is your origination fees. Every lender is going to charge a small fee for just doing the loan. That goes in section A. Along with that, if you buy points, that will be in section A as well. I'll have a longer video detailing how points work in the future, but for now, all you need to understand is that if you buy points, you're basically paying money up front to reduce the interest rate over the term of the loan. Now, section B includes other costs that you as a borrower are not able to shop for. This includes everything from your credit fee to your appraisal fee to flood certification fees and all of these other miscellaneous fees that have to be done in order to process a loan. Section C is fees that you are allowed to shop for, but are still required for the loan process. This is where you will see things like lender's title insurance and attorney fees. All in section D, you will see the addition of sections A through C so that you can see your total loan costs. This is the important number when looking at how much the loan is actually costing you. So we understand that section D shows the total cost of actually doing the loan. Let's break a common misconception that a lot of people have when they're looking at refinancing. Most people will look at the total cash to close when they're refinancing to determine their break-even point or how many months they have to hold the loan for that refinance to be worth it. So, for example, let's say by refinancing to a lower rate, we are saving $500 a month, and the total cash to close is $8,000. So most people will look at this and think that, okay, $8,000 divided by $500 a month is 16 months in order to break even. But that's not always the case. Let's say that out of that $8,000 cash to close, $5,000 was prepaid in escrows, and only $3,000 of that was actual loan costs. So the correct math would be to take that $3,000 and divide it by 500 to realize that it only takes 6 months to break even in that case, which makes a big difference between the original 16 months to the 6 months. Now that we understand the math of refinancing, let's take a look at the other costs that make up the closing costs. So the first thing we'll look at is escrows and prepaids, which take up sections F and G of a regular loan estimate. Escrow is basically a savings account that's opened by your lender, and you pay into it each month through your monthly payment. Your lender then takes that money and uses it to pay your taxes and insurance so that you don't have to worry about it. Prepaids are essentially the same thing, but this is when one of those bills is due at the time of closing, such as when you're purchasing a home and you need to pay your first year of homeowner's insurance right away. You would see that cost in section F. So the way you look at section F and G, it's not costs that are associated with the loan. They're costs that you would have to pay regardless as a result of you owning the house. Now, in sections E and H, you will see other costs that are associated with the loan that, again, are due to you owning a home, not because you're taking a mortgage. In section H, you'll see something related to your personal title insurance when it comes to a purchase. This is something you have an option to buy on a purchase. It is optional, but it's recommended, and it essentially protects you if there are any issues with the title of your home. This is different from the title insurance in section C, because that one is lender's title insurance and that one is required, and that protects the lender in case there are any issues with the title of your home. Now that we understand everything that goes into a loan estimate, let's look at how to actually compare. So when we're comparing loan estimates, instead of just looking at one thing, we're going to look at 3 different numbers. We're going to look at the note rate, we're going to look at the loan costs, not the closing costs, and we're going to look at the loan amount. So by looking at all of these 3, we'll get a clear picture and be able to compare apples to apples when looking at multiple rates. So one thing to be aware of is that these loan costs can be paid by the loan amount itself by increasing the loan amount. And this is where some lenders will try and trick you, and they'll increase your loan amount a little bit so that the amount that you're paying interest on increases to cover some of those closing costs, to make it look like it's a better deal, because they'll be offering you the same rate and lower cash to close or lower loan costs. But what you don't realize is that they've increased the amount that you have to pay off. So by looking at all 3 of these, you can get a clear picture of which rate or which loan estimate is actually the best deal for you. Now that we understand how to compare the rates and everything that goes into a loan estimate, we're going to talk about one more concept called a no-cost refinance. No-cost refinance is when you're able to refinance your rate to a lower rate without paying anything. And you may be wondering, this sounds a little too good to be true. How does this actually work? Well, most lenders will offer you lender credits, where they give you money to pay your closing costs in exchange for you taking a slightly higher note rate. Now, when you do a no-cost refinance, you will get enough lender credits to cover the loan costs that we talked about, sections A through D. You would still be responsible for bringing the rest of those costs to closing, but on a refinance, that's only going to be your escrows and prepaids, along with any extra interest that you owe. Now, when you do a refinance, your old principal balance and your old loan is paid off, and anything that was in your old escrow account is refunded to you. So you're essentially paying nothing for the new escrow and prepaid, because you'll be refunded for the old escrows. And the interest that you have to pay is roughly equivalent to 1 month's mortgage payment in most cases. And whenever you refinance, by default, you get to skip 1 mortgage payment just because of how the cycle goes. So as a result, you're paying a net of nothing in order to do this refinance. Now, this is a great deal for a lot of people, especially when interest rates drop a lot. But one thing you want to watch out for is if it's only a small decrease in rate and it's resetting your term to another 30-year loan, then you might end up paying more interest over the course of the loan. So you want to make sure that there is a genuine net tangible benefit to you before you proceed. Now, if you're located in North Carolina and you want to see if this is something that could work for you on your current home, or you're interested in purchasing a home and you're looking for a mortgage, you can apply at the link in my bio to see what the rates are like right now and see if any of these options are good for you. Thank you.